Morning. Have you tried the homework question? Try panningla. No issues. If you have not tried, I will solve it in the class. To recollect the concept especially. Okay. First, we'll do the problem for practice at home. Question number 18. Given below, the balance sheet of Modern Woods Limited as on 31st March 2023 is given to us. We are given authorized and issued capital is given. P&L account, bank OD, creditors, provision for tax, and which one? Proposed dividend is given to us. Land and building, plant and machinery, stock and debtors are given to us. The net profits of the companies after deducting which one? Usual expenses, but before providing for tax. So what is given to you is profit after tax or profit before tax? Profit before tax is given to us for the last 5 years. Okay, 2 lakh, 1 lakh 80, 1 lakh 70, 2 lakh 20, 2 lakh 20, like that it is given. Is it increasing? No. Simple average we'll use. Same like the last class, we are given value of land and buildings and plant and machinery. Debtors 4,000 irrecoverable, like that it is given to us. 10% on the net tangible capital invested. 10% return on the, is it given on the capital employed or net tangible assets? Net tangible assets means in the balance sheet you work out assets minus liabilities, like that. Value the shares based on ex dividend. Your own valuation of goodwill, which may be based on what? 5 years purchase of super profit. Tax may be assumed at what? 50%. In this question, do they give you depreciation adjustment? Any adjustment for depreciation given? See, in the last question, we were given a depreciation adjustment. What is the depreciation adjustment? 15% on plant and what? 10% on building, like that one. So, that depreciation adjustment is not given to us. So, no need to adjust for depreciation compared to the last question. So, what is the first one we have to work out? What is the first one we have to work out? Average profit. First, we let us value goodwill. This is question number. Start. First, let us value goodwill. The homework problem should have tried at home. Doesn't matter, but 1 or 2 homework problem padlina FR concept will not go to your mind. Doesn't matter, but for me doesn't matter. Okay. Start. First, average profit. What is the average profit? Tell me the profits given. Last year profit should be adjusted for bad debts. 2 lakhs minus what is the bad debts given? 4,000 plus prior years. 2,20,000 plus 1,80,000 plus 2,20,000 plus this divided by 5 years or 4 years. Minus bad debts. Bad debt should be adjusted with what? Current year profit. This is average profit before tax. This divided by 5 years. This is profit before tax. Any adjustment for depreciation given, like future depreciation will go up or come down, like that? Any future anticipated increase in expenses or decrease in income, etc., given to us? No. So, no adjustment for depreciation in this question because we are not given rate of depreciation, number 1. Number 2, no detail about future increase in expense or income is given. So, this one we will take it as future profit also, less tax. Less tax at the rate of 50%. This will give us profit after tax. This we call it as future maintainable average profit. Next thing what we have to work out is net tangible capital. It is not capital employed. It is called as net tangible capital, which means assets and liabilities as on a particular date. No need to work out average capital employed also in this question because the NRR given. NRR is given based on what? 10% on the net tangible capital invested. That means on the net assets. So what are the assets? Tell me the values. Land and building. What is the revised value? 2 lakh 80,000. Then plant and machinery. 1 lakh 20,000. Then stock. 3 lakh 60,000. No adjustments in stock. Debtors minus 4,000. 1 lakh less. What are the liabilities? Bank OD 10,000. Then creditors 80,000. Provision for tax. Ignore taxation. So we take provision for tax also how much? 1 lakh. Then proposed dividend. Once dividend is proposed, it becomes an external liability. Proposed dividend how much? 60,000. If you do that, you will get net assets. Net assets, it can be otherwise called as closing capital employed. Closing capital employed. No need to work out average capital employed. The wordings are very, very clear. NRR is based on what? Yes, sir, NRR is based on net tangible assets. NRR is based on what? Net tangible assets. Less normal profit. What is the normal profit? 7,56,000 into what is the return expected? 10%. This will give us super profit. Oh. So goodwill 32,000 into how many years? 5 years. 5 years or how many years? How many years purchase? 5 years purchase. Do you understand why are we not deducting half of the current year profit? Why are we not working out average capital employed? Because the NRR is given based on which one? Net tangible assets. So net assets into 10% gives us normal profit. Super profit is 32,000. That into 5 years. Goodwill 1,60,000. Now we'll value the shares. First, let us go for intrinsic value method. Already we worked out net assets for goodwill. 6,66,000. What is the extra asset you can take? Goodwill extra asset we can take. Then what is another extra asset we can take apart from goodwill valuation? Non-trade investments or long-term investments. If there is any long-term investment we can take, that is not given. If there is any preference share capital, we can reduce. Is there any preference share capital? No preference share capital. This will give us net assets for equity shareholders. Net assets for equity shareholders. So in this question, there is no long-term investments or preference share capital. Whatever you get is net assets for equity shareholders. 8,26,000 is the net assets for equity shareholders. This divided by number of shares. எவ்வளவு shares இருக்கு பாருங்க equity shares 6,000 shares of 100 each fully paid up. Intrinsic value 8,26,000 divided by 6,000 shares. What is the intrinsic value you are getting? 137.67 per share. Next, which value? Yield value. For working out yield value, we have to first work out ERR. What is ERR? Expected rate of return. Expected rate of return. How to work out expected rate of return? We have to first find out net profit available for equity shareholders. So already we worked out profit after tax. Profit after tax already we worked out 98,600. Is there any dividend on preference shares given? No dividend on preference shares. Is there any transfer to reserve given in the question? No. Any transfer to reserve given in the question? So if there is anything, you can just adjust it. If there is nothing given, so this will become net profit available for equity shareholders dividend. This is known as divisible profit or distributable profit or profit available for dividend. Okay. So 98,600 in this question. Now we can work out ERR. How to work out ERR? Net profit available for equity shareholders dividend divided by equity share capital. This into 100 will give us ERR. So 98,600 divided by, what is the paid up capital? 6 lakhs into 100. How much? 16.43%. For yield value, we worked out ERR. Then, how to find out yield value? Yes. ERR divided by NRR into paid up value per share. What is ERR? 16.43 divided by what is NRR? 10 into what is the paid up value per share given in the question? 100. So value is rupees 16.43 or 164.3 per share. Fair value, intrinsic value plus yield value by 2. What is fair value? 150 point. So we worked out net assets on that 10%. Okay, 66,600 super profit we get. Goodwill 5 years purchase of super profit. Including the goodwill, net assets is 8,26,000 divided by number of shares. 6,000 shares will give us which value? Intrinsic value. That is 137.67 per share. For yield value, first we work out ERR. For that, we need profit after tax available. Dividend on preference share, there is no preference share capital, no transfer to reserve. So net profit for equity shareholders dividend divided by equity share capital into 100, you get 16.43. ERR by NRR into paid up value per share gives us yield value. So fair value is the average. Done. Go to the 19th question. We are given land and building, plant and machinery, patents and trademarks, stock, debtors, bank balance. Preliminary expenses will not have a value? No. Then we are given creditors and provision for income tax that will be taken as a liability. That will be taken as a liability. Then this is similar to what we have done in the last class, only the numbers are different. Same. Even total also, instead of 4,60,000, it is what? 460. Okay. Even the numbers are same, only zeros are different. Only number of zeros are different. But in this question, profits will be simple average profit. Profit per 92 lakhs, 88 lakhs, 96 lakhs. This will be which profit? Simple average profit you have to take. Debtors, how much found worthless? 8 lakhs found worthless. That will be adjusted in the last year profit. That will be adjusted in which one? Last year's profit. They transfer how much? 25% to general reserve. Similar type of companies earn 10% on the value of shares, that is NRR. Plant and machinery, land and building depreciated at what? 15 and 10% respectively. Similar to last question. Okay, similar to last question. Only thing is that average profit will be different. And in the last question that we solved, that is question number 15, we were given ignore taxation. We were given which one? Ignore taxation. So we ignored that provision for tax. In this question, we will not ignore because no such mentioning is there. Is it given that ignore provision for tax? No. So it will just take 2-3 minutes of time for us to solve. Start. Whether we have to value goodwill or goodwill value is given to us. Goodwill value is given to us. 160 lakhs is given to us. Start. First, which value? Question number 19. So land and building value 240 lakhs, plant and machinery 120 lakhs, goodwill how much is given? 160 lakhs, patent 20 lakhs, stock 48 lakhs, debtors minus 8 lakhs. Debtors minus 8 lakhs, it will be 80 lakhs. Bank balance 52 lakhs, creditors, and we have to consider provision for tax also. So how many equity shares are there? 2 lakhs equity shares are there in lakhs. Ellame rupees in lakhs. All these are in lakhs. So even number of equity shares in lakhs, you can take it. Since everything is in lakhs, we take number of equity shares also in which one? Lakhs. Everything is same. Only thing is that they are not asking you to ignore which one? Provision for tax. We consider provision for tax also. We consider which one? Provision for tax also. Net assets for equity shareholders divided by number of equity shares gives us what? Intrinsic value per share. For working out yield value, first work out average profit. Simple average profit. Last year profit should be adjusted for bad debts. 96 minus, what is the bad debts? 8. Then there is going to be a adjustment for depreciation earlier. Land and building value had gone up because of the depreciation will go up. Less additional depreciation on increase in land and buildings. Look at the land and buildings value, book value, 240 lakhs minus what is the book value? This into how much percentage? Add decrease in depreciation due to reduction in land and machinery. What is the book value? 15%. This is not a new one for us. When the value of asset goes up, we claim as a book value of asset as depreciation. Simple. Valuation of goodwill happens at the time of amalgamation, mergers, and takeover, where we record assets at what value? Fair value. We had seen Ind AS 103 recommends what? Fair value. So old company was charging depreciation on 110 lakhs. We are going to charge on 240 lakhs. So depreciation will go up because of that. Reportable profit will come down, and plant and machinery reverse effect will be there. This is your future maintainable average profit. Yes, less dividend on preference shares. Any preference share capital? No. Less transfer to reserves. How much percentage? 25%. On this 25% we transfer. This will give us net profit available for equity shareholders dividend. This divided by paid up equity share capital into 100. This will give us ERR. What is the paid up capital? 200 lakhs. Everything in lakhs into 100. ERR by NRR into paid up value per share. What is NRR? How much percentage NRR? Into what is the paid up value? 100. What is the fair value? Shall we? Shall we proceed? Now we'll understand or learn about partly paid up shares. We'll learn about which one? Partly paid up shares. Very simple to value. If there are partly paid up share, what is a partly paid up share? Some calls are yet to be made. Some calls are what? Yet to be made. Okay. Make a notional call. What do you mean by notional call? It is not an actual call. Think that if the shares are fully paid up, what will happen? For example, let us assume type 1. You are holding 1 lakh shares of 100 each fully paid up. 1 lakh shares of 100 each fully paid up. Second category holds 1 lakh shares of 100 each, but 80 rupees paid up. 80 rupees paid up. What is the balance 20? At any time, the company has the right to call the money. Suppose if the company calls the money, what will happen? Suppose if the company calls money, what will happen? That is called as what? Notional call. We are not going to call. If the company calls money, what will happen to the assets? When a company is calling the unpaid amount, the cash will come in. Because of that, what will happen? Net assets will increase. Net assets will increase. Start. Notes. Intrinsic value. Start. Intrinsic value of partly paid up shares. Intrinsic value of partly paid up shares. Notional calls. Notional calls. Notional calls means if the partly paid shares are collected or called and collected, comma, the net assets will increase. Based on the above, net assets for equity shareholders is calculated. So if the calls are collected, the net assets will go up. Based on that, the net assets for equity shareholders is what? Calculated. We'll see. We'll apply in a question so that you will understand better. Okay. We are going to solve from your ICMA material. Okay. Shall we? Have we taken up this? Look at this question number 20. This is I've taken from my ICMA material. The same question. 180 lakh equity shares of how much? 10 each, 1800 lakhs. 90 lakh equity shares of 10 each. How much paid up? 8 paid up. Wait. Please remember, this is also 10 each. This is also 10 each. But second one is how much paid up? 8 paid up. Look at the third one. Is it face value itself is different? 5 each. Face value itself is different. Clear? We've got different face value, different paid up value also. Now, in this 3 category, where we will be able to call the money? From this 90 lakh shares, we'll be able to collect how much? 2 rupees. So our net assets will go up by what? 90 into 2, 180 lakhs. It will go up by what? 180 lakhs. Other than that, it is same. Goodwill is given, fixed assets are given, current assets are given, loans and advances are given. Then secure loans, current liabilities are given to us. Secure loans and which one? Current liabilities are given to us. We can work out net assets. We can work out what? Net assets. Based on that, we can do. Calculate for each of the 3 category of shares, which value they ask you to work out. Intrinsic value based on which one? Book value of assets and liabilities, including what? Goodwill they ask for. Then next one is based on which one? Dividend yield, we'll come to that later. Then based on which one? EPS, we'll come to that later. So first let us work out which value? Intrinsic value. Read the question, then we'll solve. Read the question once again, read the balance sheet once again, then we'll work out. How to work out? Simple. We'll take the same goodwill, fixed assets, current assets, loans and advances. We will take, no revised value is given. We'll take which value? Book value, secure loans, current liabilities and provisions you will take. Current liabilities and which one? Provisions you will take. That's an alignment error. Please change this. Secure loans 4,500. Current liabilities are correct only. 1242. Provisions are how much? 960. Oh, correct. So these are the liabilities we'll deduct. These are the liabilities we'll deduct. Start. Which value we'll work out first? Assets. Since book value of assets are taken, okay, any asset to be eliminated here? Any asset to be eliminated? Goodwill, other fixed assets, current assets, loans and advances. Any revised value is given? No. Any asset to be eliminated like preliminary expenses, discount on issues given? No. So we can just take total assets as per balance sheet. Because book value is only asked for. What is the total assets as per balance sheet? 15,429. Less liabilities. What are the liabilities? From the end, let us go up. Provisions. 960. Then what is the next one? Current liabilities. Current liabilities how much? 1242. Then secured loans 4,500. Any other liability like preference share capital? No preference share capital also. Assets minus liabilities will give us, this is net assets. This is net assets for the existing paid up capital. 8727. So if there are partly paid up shares, add which one? Notional calls. If there are partly paid up shares, add which one? Notional calls. Which category is partly paid up in this? 90 lakh shares of 10 each, 8 paid up, so 2 will call up. 90 lakhs into 2 rupees. How much? 180 lakhs. If you add up, this is called as asset backup. Asset backup, otherwise net assets for equity shareholders. Wait, this problem was tested in the past examination twice, but twice or thrice they asked the same problem. But in suggested answers, I find once they have given an answer, for another one they have given another answer. For same question, they have given two answers. Okay, but the answer that is given in your study material is not logically correct. That is not logically correct. Okay, in RTP also one answer is correct, one answer is wrong. But anyhow, we are learning for examination. Okay, let us. It will take just 2 minutes of time to understand both the concepts. Okay, let us present. If this approach is followed, this is the answer. If the approach is followed, this is the answer, like that. So that if the question is for 10 marks, we will not lose any mark. The first approach is, let me go for the wrong approach. Okay, so what is the asset backup? 8907. Okay, net assets 8907. Since we are given different paid up values, since we are given what? Different paid up values, let us take paid up capital. This will give us net assets divided by paid up capital, not number of shares, because we are not given equal face value. This will give us value per rupee of capital, per rupee of equity share capital. Clear? This will give us value per rupee of equity share capital. What is the thing? Look at 180 into 10, how much? 1800 lakhs, 1800 lakhs plus. This is also fully called up. This also we made notional call. So 90 into 10, 900. We made a call. We made a call and collected 180 also. So once it is collected, it becomes like what? Fully paid up share. Then 150 into 5, 750. So if all the shares are fully paid up, this will be my equity share capital. This will give me value per rupee of capital. This will give me what? Value per rupee of capital. For every 1 rupee of capital, what is the value? Every 1 rupee of capital, what is the value? What is the value? 2.5817. This is value per rupee. Value per rupee of capital. Simple. If it is rupees 10 paid up, if it is rupees 10 paid up, 10 rupees into 2.5817. 2.5817. 10 into 2.5817. This is the value. 1 rupee value of that much means what is the value for 10 paid? If it is rupees 8 paid means 10, sorry, 8 into 2.5817. How much? 20.654. Then if it is rupees 5 paid means, okay, face value is also 5, paid up value also 5 means 5 into 2.5817. Okay, 5 into 2.5817. This is the value. This is the value. Once again, I repeat. What is the asset backup available to equity shareholders? 8907. What is the paid up capital? 1800. Why do we take 900 here? Those shares are also fully called up now. We have done a notional call plus 750. This will give us value per rupee of capital invested. So if it is 10 rupees now, this value. If it is 8 rupees now, this value. If it is 5 rupees means this value, like that we work out. According to me, this method is logically not correct. Logically not correct, but your ICMA textbook gives this answer. So suppose if examiner is going to correct the paper, we are learning for examination. We are learning for which one? Examination. If the examiner is going to correct with this answer, you do this answer. But what answer is logically correct is we have to go by equivalent production method. What method? Equivalent production method. Weight. Let us assign the weight of for rupees 10 paid up share. For rupees 10 face value shares as X. Let me take it as what? X. If there are 10 rupees face value shares, let me take it as what? X. If it is rupees 5 face value shares, it will be what? 0.5x. If the shares are having 10 rupees face value, let us assign X full weight. If the shares are having 5 rupees face value means 0.5x. So if you apply this method, pay attention, net assets divided by weighted number of shares. Weighted number of shares. This is the correct approach. This is a correct approach. And logically prove also how it is correct also. What is the net assets? 8907 divided by, okay, this 180 lakhs is 10 rupees face value. This 90 lakhs is 10 rupees face value. And please remember, we collected this two also. Partly paid up shares also collected, notional call, including that only asset backup we got. So we'll assign X weightage, which means for this 180 plus 90, we'll assign what? X weightage. So it will be like 180 plus 90, 270X plus for this 150, we'll assign what? It is face value is how much? 5 rupees. 5 rupees. So 170, that is 150 into 0.5x will be what? 75x. 75x. So get the x value. 8907 divided by 270 plus 75, 345. You get 25.817. 25.817. Wait, pardon. I logically prove this answer also. Sir, we are getting the similar answer, but it is not similar. Wait, pardon. If the share is having, pay attention. If the share is having, pay attention, everybody. Don't copy this. Rupees 10 face value. Rupees 10 face value and fully paid up. 10 face value and fully paid up means what will be the value per share? 25.817. If it is having 10 face value and if it is only 8 paid up na, simple, 25.817 minus 2 rupees. Why minus 2 rupees? Logically understand, let us assume you are purchasing from me a fully paid up share that is stated for 25.817. You are purchasing fully paid up share from me for how much? 25.817. He is holding a partly paid up share. How much you will be ready to pay for that? 2 rupees less you will pay. Why? In future, if the company is asking, I have to pay the 2 rupees. I have to pay that 2 rupees. So 25.817 minus 2 will give you what? This is the value. Otherwise, compared to fully paid up share, partly paid up share will be traded for 2 rupees less. If it is rupees 10 face value share, that is, 5 rupees face value share. 5 rupees face value share, it is 0.5x. Yeah, 0.5x. If x is 25.817, it will be 25.817 into what? 0.5x. 25.817 into 0.5x. How much will be the value? 12.909 is the value. This is the correct answer according to me and logical answer also according to me. Sir, how do you prove it? I will prove it later. Once again, the textbook approach let me to go for. Net assets, add notional call. If calls are collected, what will be the asset backup? 8907. Value per share will be net assets divided by paid up capital. It will give us what? Value per rupee of capital. For every 1 rupee of equity capital, what is the value? So 10 rupees paid na 10 into this value, 8 rupees paid na 8 into this value, 5 rupees paid na 5 into this value, like that we work out. But the value difference comes for which one? 8 rupees paid up share. Because they also assume for every 1 rupee, the value will change in the market. It will not be so. If a person is holding 10 rupees paid up share, the person is holding 10 rupees paid up share, it will go for 25.85817 means if you hold a partly paid up share, it will go for that lesser value. What is that lesser value? 2 rupees. Why? You buy in the market for 23.817. If the company is asking, you pay to the company how much? 2. It will be like here it is how much? Proportionate of தப்பு ஏன்னா here how much you will pay to the shareholder. For example, let us assume you are buying a partly paid up share. How much you are paying here as per this? 20.654 to the partly to the company. How much you have to pay? 2 rupees. So what is your total cost? 22.654. Your shares are fully paid up now. But if you buy a fully paid up share in the market, it will be like 25.817. 10 rupees paid up share, you buy in the market for how much? 25.817. If you buy a partly paid up share according to the first calculation, it comes to only 20.654 plus 2 rupees you have to pay to the company. It will become only what? 22. That is not logically correct. That is not logically correct. And we can prove our answer also. In this category, how many shares are there? In this category, how many shares are there? 180 lakhs. In this category, how many shares are there? 90 lakhs. In this category, how many shares are there? 150 lakhs are there. If you multiply, you will get the total value of shares. This into 180. If you multiply, you will get which one? Total value of shares. And if you add up all the values, it will come to approximately 8907. Right. No. Because of the fractional round up, it changes. What is the value of X? Is it correct first? 270. What is the total you are getting? Wait. What is the total you are getting? 8726.9. 8726.9. Check this. What is the value of asset? What is the value of asset? 8727. Here the 0.1 differs because of the on the rounding off. Otherwise, wait. Here I have taken 10 rupees value or 8 rupees value. This category. Did I take 10 rupees value or 8 rupees value? 8 rupees value only. So 8727 only will come. In this, if you add the notional call, the total value will come. But in this one, you cannot verify. Same thing you do, you cannot verify. You multiply it and add up and see, you cannot verify. This verification is only for the purpose of learning. Don't copy this. What is the total you're getting? No, this is 90. This is 75. This is 75. You get how much? 7474 only. But what is the total asset backup? 8727. So this method is not logically correct. The first method that we work out is not logically correct. But since we are doing it for examination point of view, I request you to give both the answers in the exam. Okay. Based on per paid up capital, you work out value per share. Based on paid up capital, you work out value per share. Once again, I repeat. For every 1 rupee of capital, the value is 2.5817. So 8 rupees how much, 5 rupees how much, 10 rupees how much, like that they worked out. If you multiply, you will not get the total of 8727. Okay. Now, what is logically correct is going by which method? Equivalent production method. If it is 10 rupees face value share, it is how much? X now 0.5x will be what? 5 rupees face value share. 270 lakhs is there. Oh, 180 plus 90. 270 lakhs X now. The other one, 150 into 0.5x, it will be what? 75x. X value is 25.817 means for a 10 rupees paid up value, this is a value. 10 face value, 8 rupees paid up means it will be what? 2 rupees lesser than that. And if it is 5 rupees paid up, it will be, half the value of the 10 rupees share. This is the logically correct answer. But in your textbook, I find, they have given this answer. The first answer, 25.8, 20.64 and what? 12.9, like that they have given the answer. But next problem, they changed to our equivalent production method. Next probably they changed to which one? Equivalent production method. They worked out 1,30,000 x, 33,000 x, total how much? 1,63,000 x, like that they worked out. But let us not change our answer according to ICMA, but we should be prepared for exam also. Give this answer as well as this answer. Okay, you can just give it as an alternative approach. You can give it as which one? Alternative approach. Okay, suppose if the examiner looks at this answer, okay, the student has presented alternative approach. Okay, they will award marks. It will just take 2 minutes of time. Anyhow, we are going to work out which one? Net assets. So let us give both the answers. But according to me, what is logically correct is going by which method? Equivalent production method is correct. Please remember, we worked out only which value? என்ன value work out பண்ணிருக்கோம்? Intrinsic value method. Once again, repeat, because it's most important for exam. First approach is based on for every 1 rupee of capital, what is the value? Okay, for every 1 rupee of capital invested, 2.5817. So 10 rupees, 8 rupees, 5 rupees, what is the value? It is a proportionate formula that is not working out logically also. Second approach is based on for a 10 rupees face value, if you assign X weightage, for 5 rupees face value, it should be what? 0.5x. So how much is the value? If it is 8 paid up, 2 rupees lesser value. If it is 5 paid up, half the value, like that. Take up this. The problem is not over. The problem is not over. They ask you what other approaches also. They ask you to work out the shares based on which one? Dividend and which one? EPS. That is very simple to work out. Take this as an alternative approach. Do you understand why do we make notional calls? Since there are partly paid up shares, they are also called up. What will be the asset backup? Based on that, we work out value per rupee, then multiply it with paid up value. The second approach is based on for a 10 rupees face value share, when you give a full weight for partly paid up share, there is 5 rupees face value, we should assign what? 0.58. There is 0.58. Proceed பண்ணலாமா? Do you understand the second approach, the proper logic? Because more than a number, you should understand the logic behind it so that you will be remembering. Here, you are purchasing 10 rupees share for 25.817 means 8 rupees share you will be buying for 2 rupees lesser than that. Clear? Because your obligation towards the company in the future will be what? 2 rupees. The company calls 2 rupees, you have to pay it. So to the holder of the share, you pay 23.87. Later on, if the company calls, you pay 2 rupees to the company. So that you also become like a 10 rupees shareholder for 25.817. Next, they ask you to work out the value based on dividend based. Based on which one? Dividend. What is the industry dividend yield given? 15%. This is like normal rate of return, normal rate of return. But we are paying 20%. This is like expected rate of return. What is the normal rate of return in the industry? 15%. What is the expected dividend of the company? 20. Expected dividend of the company is how much? 20. Shall we start? Dividend based value. We know the formula, expected rate of return divided by normal rate of return into paid up value per share. So அப்படியே இதை convert பண்ணா, instead of expected rate of return, simple, expected dividend divided by what? Industry average or normal dividend into paid up value per share. We've got three different categories, rupees 10 paid up, rupees 8 paid up, and rupees what? 5 paid up. 20, 20 by 10, 20 by 15. Into paid up value per share. What is the paid up value per share? 10 rupees. This is based on dividend. ERR by NRR into paid up value per share. 20 is the dividend from the company, 15 is the industry average into 10 rupees per share. Like this, you work out for others. Any doubt in this dividend based value? Expected rate of dividend from the company divided by normal rate of return in the industry into paid up value per share. We get the value. Next, which one? Look at the question asked. Based on which one they asked for? EPS. Based on EPS. How much profit is earned by the company? 1371 lakhs profit is earned by the company. Average EPS of the fully paid up share, 10 rupees in the industry is how much? 2 rupees. So simple. If you work out the normal rate of return, 2 rupees for every 10 rupees paid up into 100. This will give us like 20%. What is EPS in the industry? What is EPS in the industry? 2 rupees for every 10 rupees into 100 will give us the normal rate of return in the industry. This is the normal rate of return in the industry. Now for this company we have to work out. What is the are we given the same paid up value or different paid up value? 180 lakhs, 90 lakhs, 150 lakhs. Are they having the same face value and paid up value? No. So we have to work out not earnings per share, earnings per rupee of capital, rupee of paid up capital. What is earnings of the company given? What is earnings of the company given? Adjustment la kuduthirukam parunga. What is earnings of the company? 1371. See, if number of shares are given with equal paid up value, we'll work out profit after tax minus dividend on preference shares, earnings available to equity shareholders divided by what? Number of equity shares. Normal EPS we'll work out. But in this question, whether the number of shares are having or all the shares are having equal paid up value? No. So net profit divided by paid up capital. What is the paid up capital at present? 1800 plus 720 plus 900 கிடையாது. The notional call the 900. Current invested capital 750. This will give us earnings per rupee of capital. Divided by, what is the total? 1800 divided by 720 into 750. 3 to, this will give us earnings per rupee of paid up capital. Earnings per rupee of paid up capital. Wait பண்ணுங்க. So value per rupee. You can apply the same formula. ERR by NRR. Okay. Into paid up value per share, like that you can apply. Or simply we can work out. Okay. Do you remember what is the formula for cost of equity? EPS by market price into 100. EPS by market price into 100. So the cost of equity, this is 20% can be taken as what? Cost of equity. This can be taken as what? Cost of equity. Simple. A person is ready to invest 2 rupees for a 10 rupees share. Okay, sorry. 2 rupees is expecting to earn on 10 rupees share means 20% is expecting. This can be taken as which one? Cost of equity. So all think பண்ணவே தேவையில்லை. Okay. Value per rupee of capital is nothing but how much we are earning? This divided by what is expected rate of return? 20%. This is a value per rupee of capital. This is a value for every 1 rupee of capital. So if it is rupees 10 paid up, what will be the value? 10 into this value. If it is rupees 8 paid up, 8 into this value. If it is rupees 5 paid up, 5 into this value. Wait, I'll give an alternative answer also for this. This into how much? 10 rupees. This into how much? 8 rupees. And this into how much? 5 rupees. Once again, I repeat. What is NRR? 2 on 10. 2 on 10 means 20%. That is what is expected by shareholders. So earnings for every 1 rupee of capital, how much we get? 0.4193. For every 1 rupee invested, the company earns 0.4193 means what will be the value per rupee of capital? 2.0963. So for 10 rupee, what is the value? Like that we work out. There is an alternative approach. Wait பண்ணுங்க. What is the EPS per rupee of capital we worked out? What is the EPS per rupee of capital we worked out? 0.4193. 4193. Therefore, for rupees 10 paid up, EPS will be 10 into what? 0.41927, whatever. So this will give us EPS for rupees 10 paid up. Multiply it. How much you get? $4.1927. Okay, for rupees 8 paid, EPS will be 8 into. How much you get? 2.0965. This is the EPS. This is the EPS. Value will be EPS divided by NRR. EPS divided by NRR. So this divided by what is NRR we worked out? 20%. You will get approximately the same answer. Same answer you will. Here we work out earning per rupee of which one? Capital. Earning per rupee of capital. We work out value per rupee of capital. For every 1 rupee of capital, what is the value we work out? Then we multiply with paid up value. Alternative approaches, wait பண்ணுங்க. Earnings for every 1 rupee of capital is this much na. 10 rupees capital, 8 rupees capital, 5 rupees capital. What is EPS? We work out. Based on that, we work out which value? Yield value. This is an alternative approach for EPS. But this is more logical and more easy also. Don't think too much, pay attention. What is NRR? 20%. For every 1 rupee of capital invested at present, no notional calls here, only for asset backup notional call. What is the company earns for every 1 rupee invested? 0.4193. 0.4193, shareholders expect 20%. Now, how much they will be ready to pay? 2.0963. So, depending upon the paid up value, the shareholders will be ready to invest the money. This is the most prominent and best approach. You can work out by this approach also. இது இந்த ஃபார்முலா எல்லாம் கஷ்டமா இருக்குதுன்னா ரொம்ப சிம்பிள். இன்னொரு மெத்தட் இருக்கு. ரொம்ப சிம்பிள். If EPS is 2 rupees, you are ready to invest how much? 10 rupees. இங்க if EPS is 0.4193, நீங்க எவ்வளவு இன்வெஸ்ட் பண்ண ரெடியா இருக்கு? கிராஸ் மல்டி கூட பண்ணலாம். Clear? 0.4193 into 10 by 2. How much will come? That's approximately this answer. That is because of rounding of fractions. I'll approach Pona, it will be confusion. So this is simple and neat, okay. And of course, one more approach is always good. Paid up value into value per rupee gives us what? Value of the share. If this model question is tested in the exam, it will be for minimum of 10 marks, maximum of 15 marks. You have to work out asset value, dividend based value, then what? Earnings based value. So this is dividend based value. Proceed பண்ணலாமா? Those who completed, please read question number. Question number which one? 21. Read question number 21. If you look at in FR or in BBM, one of the most repeated question is this question. Most repeated. If you look at last 10 years question paper in goodwill and share valuation, the same question without even changing the number got repeated about 3 times for 15 marks. Where you have to value goodwill, then you have to value shares using which method? Intrinsic value method. Then you have to work out under which method? Yield value method. And there are a lot of rectification of errors would have been given in the profit. 1 year machinery would have been wrongly charged, 1 year overvaluation of stock, income from non-trade investments, so many things would have been included. Please go through that. You must read the question at least twice or thrice before we solve. At least ஒரு ரெண்டு வாட்டியாவது படிச்சீங்கன்னா தான் question paper you will understand. Read it. You must read it completely. All adjustments you have to read it completely. A lot of thinking is involved in that question. Read the question. 21. 10 each fully paid up, 10 each 8 paid up. 5 each fully paid up, 5 each 4 paid up. Okay. That null is only for our final answer. Then we are given P&L account. Preference share capital is also given to us. Debentures, loans, deposits, bank loan, creditors, outstanding expenses, provision for tax, accrued preference dividend is given to us. Okay, goodwill, plant and machinery, land and building, furniture, investments, stock, debtors, prepaid expenses, advances, cash and bank balance are given to us. Look at that. In 2013, a machinery was purchased but wrongly charged to which one? Revenue. Drone rectification has been made for the same. Suppose the profit of 2013 is given, you would rectify. But in your profit is given from 2015. And please remember, in 2013, like that, it is given to us. Let us see. Stock is overvalued by 10,000. If closing stock is overvalued, what will happen? Profit will be overstated. So you would reduce it. Wait. This year closing stock overvalued. Next year opening stock gets what? Overvalued. Because this stock is carried to next year. So this year, if closing stock is overvalued, what will happen? Profit will go up. So we have to rectify that. Next year, subsequent year also, opening stock is overvalued. If opening stock is overvalued, what will happen? Profit will reduce. We have to rectify that. We have to rectify that. Then debtors reduced by 5,000 means bad debts in 2017. Some old furniture book value 10,000 was disposed of for how much? It's like loss on sale of asset. Is it a non-recurring loss or recurring loss? Non-recurring items, what you should do? Non-recurring expenses, expenses that will not come again. Abnormal items, you will add back. You will add back. Fixed assets are worth 5% more than the book value. Depreciation and appreciated value of fixed assets, except machinery, not to be considered for what? Goodwill valuation. Look at point number 4. Of the investment, 20% are trade investments. Balance is what? Non-trade investments. All trade investments are valued at 20% below the cost. See, for goodwill valuation, we can trade investments. For goodwill valuation, we can take trade investment. Non-trade investment should not be taken. Non-trade investment should not be taken. Then 50% of the non-trade investments were purchased in June 2016 and remaining was purchased in what? 2017. A dividend of 10% is earned on all investments. Then expenditure increases by 20,000. R&D cost will be 30,000 per annum. NRR, normal rate of return on capital employed, how much is given? 10%. And look at the words. Profit after tax is given to us. Current income tax is how much? 50%. In future, the income tax will be 40%. Calculate intrinsic value of different categories of equity shares. For this purpose, goodwill may be taken at what? 3 years purchase of super profit. Depreciation is charged on machinery at the rate of what? 10% on reducing system means WDV method. So this is question number. We are given how many years profit? 2015, okay, 2016, 2017. Profit after tax given. What is the profit after tax given? 2,10,000, 1,90,000, 2 lakhs. Wait, this is after tax. We have to convert into before tax and do the workings. Why? Because in future your tax rate is going to be 40% and all the adjustments are subject to what? Tax also. So what will be the profit before tax? This 50%, clear, 100 rupees and manna, we pay 50. So profit after tax will be 50. This is profit after tax. This will become before tax. If you're earning 100, you pay tax of how much? 50. After tax, it is 50. So this is what is given to us. Profit after tax is given to us. So what will be the profit before tax? Double the amount. So 4,20,000, 3,80,000, and 4 lakhs. This is the profit before tax. This is the starting point of our working. This is only for reference. This is only for reference. Wait, you have to adjust for stock valuation, bad debts எல்லாம் adjust பண்ணணும். And some rectification of errors. Machinery wrongly charged to P&L account, அதோட depreciation effect you have to consider. Then work out what? Rectified profit before tax. I'll tell you how to do it, then you can do it. Then you work out average profit. You work out which profit? Average profit. After working out average profit, okay, profit before tax work out பண்ணுங்க. Then work out which one? Average profit before tax. Before tax. And for future, some adjustments are given. Expenditure increases by how much? 20,000. What will you do? Less increase in expenses in future. We'll reduce it. Less R&D cost of future. R&D cost in future. How much R&D cost in future given? 30,000 given. This will give us future maintainable average profit before tax. Before tax, less eவ்வளவு percent tax? In future, it is going to be 40% tax. This will give us FMAP after tax. After tax for goodwill. For goodwill valuation. Wait. Here you have to eliminate income from non-trade investments also. Income from non-trade investments. Why? Because we are working out goodwill based on which one? Operating income. Income from non-trade investments also you have to eliminate. That machinery, some adjustments are given, you have to adjust. And work out which one? Rectified profit before tax. Interla நம்ம rectification of errors எல்லாம் பார்த்திருக்கோம். Apply that and try to work. Try பண்ணுங்க. So these expenses come only in the future. Then work out profit before tax minus tax. So before we go for all these adjustments, work out this value and tell me. Rectified profit before tax for the past, you just work out and tell me. Think and work out correctly and let us see. And there will be some more item you would reduce. Loss and sale of assets also. Or add back. Furniture. Because it's a non-operating item, we will add back. Or non-recurring loss, we will add back at the market. So first work out this part and let us see. Let us see. Let us work out the answer. Wait. See. In 2013, a machine costing how much was purchased? 50,000, but was wrongly charged to revenue. We have given profits of which year? 2015, 16, and which one? 17. Profits of 2016 and 17, and this one is given. I hope there was a typing error in the question. Let us see. Typing error. I'll check with the original question. Wait. Actually, error is like end of 2014 is actually. இது வந்து end of 2014 அதுக்காக நான் தப்பா போட்டேன்னு சொல்லக்கூடாது. ஓகே, end of which one? 2014. Okay, end of 2014 and new machinery was purchased, but we are given from which one? 2015 only, so we cannot rectify in 2014 profit, but this was purchased from the end of when the machine was purchased, end of 2014. Now we have to provide depreciation on omitted machine. So 10% will be how much? 5,000 WTV. So 50,000 minus 5,000, 45,000 into 10%, 4,500. Okay, 45,000 minus 4,500, 4050. This is the depreciation on the omitted machine. Why do you provide depreciation? Because this was wrongly charged to which one? The revenue means it was not taken as an asset. It was not taken as an asset. We have to provide depreciation for that. What is the next one given? Stock is valued 10,000, overvalued in 10,000, 2016 கொடுத்திருக்கோம். So less overvaluation of stock. In 2016, we overvalued, because of that the profit would have gone up. Eliminate the 10,000. Then add back overvaluation of which one? Opening stock of 2017. If closing stock of 2016 is overvalued, automatically next year's stock is overvalued. So add back 10,000. Why do we add back 10,000? If opening stock is overvalued, profit reduces, we have to add back. Then what is the next one? Furniture sold for a loss of 4,000. Add abnormal loss or non-recurring loss. We add back because this loss will not come again. How much? 4,000. Then what is the next one? Fixed assets worth 5% more than the book value. Depreciation on the appreciated value of fixed asset except machinery not to be considered. We will see that, no issues. Then anything related to datas where it is given? Second point. Okay. Bad debts how much? 5,000 you have to provide. Then look at this. Of the investment, 20% of trade investments. Okay, let me do a separate working note for that. Separate up பண்ணிக்கிறேன். Investments ஓட total value எவ்வளவு கொடுத்திருக்கோம் balance sheetல? 3 lakhs. In this, 20% are trade investments. What is 20%? 60,000. It is valued at என்ன சொல்லிருக்கோம்? All trade investments are valued at 20% below cost. Less 20% ought to be valued. Ought to be valued. To be valued means there is a reduction in the value in the market. So 20% reduction in the market value is there. So what is the fair value of the investment? 60,000 minus reduction 20%. This is the fair value of the investment that we will consider for capital employed. That is about trade investments. Balance non-trade investments. Balance or non-trade investments. எவ்வளவு non-trade investments இருக்கும்? 2,40,000. 60,000 trade investments. Remaining 2,40,000 is which one? Non-trade investments. Wait பண்ணுங்க. Non-trade investments. Okay, look at that. 50% of the non-trade investments were acquired in which month? January 2016. So in the 2,40,000, 50% was purchased in 2016. Balance 50% was purchased in 2017. Okay. Now, which means how much we purchased? 1,20,000 we purchased in 2016 and remaining 1,20,000 we purchased in what? 2017. This is the detail about which one? Non-trade investments. Non-trade investments. Now wait for that. We'll eliminate income from non-trade investments. Non-trade investments. Wait. What is the total non-trade investments? Did we purchase in 2015? No. Did we purchase in 2016? Yes. How much was purchased? 1,20,000 into what is written on non-trade investments? 10% is earned. 10% is earned now. Give 12,000 over. So how this 12,000? How this 12,000? 1,20,000 into what? 10%. 1,20,000 into 10%. 12,000. Okay. Second year in 2017, what will be the income from non-trade investments? 2016, we acquired 50%, so income is 12,000. In 2017, what would have happened? This is already there. Plus, we purchased how much? 1,20,000. So how much it will be? 2,40,000 into 10%. 2,40,000 into 10%. Why? Because 50% was acquired in the last year, remaining 50% in the current year. So 12,000 will come. Eliminate. Sorry, 24,000. See, last year itself we purchased 1,20,000. On that income is 12,000. Current yearly we purchased how much? 2,40,000 into 10%. How much? 24,000. This will give us profit before tax or rectified profit or operating profit before tax. Operating profit before tax. Take up this first, then we'll proceed. So average profit, how to work out? Add up all the three divided by 3. You can take it up. Actually, my textbook, the data is given properly, but they've taken 12,000 over here, this 24,000, 24,000 like that they've taken. That is wrong. And the furniture purchased in 2014, adjusting in 2016 is an error. So please do not consider textbook answer. This is a correct authenticated answer. Yes. If it is given as start of 2014, already 5,000 for last year, 4,500 like that we used to adjust. It is end of 2014 the machine was purchased. Machine not a furniture. Machine. 50% was purchased in 2016, remaining 50% was purchased in 2017. Probably they'll correct the material in the next edition. But for this question, this is a solution. Less increase in expenses. What is increase in expense in future given? Increase in expense in the future 20,000. Then less increase in R&D or R&D expenses 30,000. Then then additional depreciation on machinery. Additional depreciation on machinery for the future you have to work out. This will give us future maintainable average profit before tax. In future, less tax will be how much percentage? 40%. This will give us FMAP after tax. For goodwill valuation. Any doubt in depreciation on omitted emission? Any doubt on depreciation on omitted emission? Any doubt in adjusting the value of stock? Abnormal loss will be added back. Bad debts to be provided. Eliminate income from non-trade investments. 50% was acquired in the last year. Remaining 50% also acquired in the current year. So you'll get this value. Operating profit before tax we get. Average profit is this much. Any doubt in increase in expenses? They've given directly. Increase in R&D 30,000. Now everybody paying attention. It is a most important adjustment also. A minor important adjustment, most important adjustment. Paying attention. Look at point number 3. Fixed assets are worth 5% more than the book value. Depreciation on appreciated value of fixed assets except machinery not to be considered for valuation of goodwill. What is the meaning then? See, when fixed asset value goes up, depreciation also will go up. They ask you to ignore except for which one? Machine. So for machine alone, we have to consider additional depreciation. What is the depreciation rate given? 10%. Look at the asset side. What is the machine value given? 8 lakhs. So additional depreciation on machinery, 8 lakhs. It goes up by how much percentage? 5% into 10%. Will you put? What is the value of machine given in the balance sheet? 8 lakhs. How much it appreciates? Look at the adjustment. It goes up by how much percentage? 5%. 5% more than the book value. On that, what is additional depreciation? 10% you will provide. No. Pay attention. Machinery in the balance sheet. What is the machinery in the balance sheet? 8 lakhs. Pay attention. 8 lakhs. Add omitted machine. The machine was wrongly charged to revenue. What is the machine charged to revenue? 50,000, but will it take 50,000? No. 3 years depreciation. What is the depreciation? 5,000, 4,500 and what? 4050. What is the book value of omitted machinery? Please remember this 50,000 is not purchased in current year. When it was purchased? End of 2014. So we charge depreciation for 15, 16 and 17. What is the book value of omitted machinery? 36,500. 36,450 varum. So the book value of the asset is 8 lakhs plus what? 36,450. This value increases by 5%. So you have to take 8,36,450 into how much appreciation? 5% appreciation. On that, what is additional depreciation? 10%. 8,36,450 is the value of the machine, book value of the machine. That goes up by how much percentage? 5% into 10% depreciation. Take this. Once again, I repeat. What is the book value of the machine? Including omitted machine, what is the book value of the machine? 8, 8 lakh is given in the balance sheet. Omitted machine would have value, and what is the value today? 50,000 minus 5,000 minus 4,500 minus 4050. What is the value today? 36,450. So what is the book value of the machine? What is the book value of the machine? 8,36,450. That goes up by how much percentage? 5%. On that additional depreciation, how much percentage? 10%. So 4182 will be the depreciation for the future. Additional depreciation for the future. Adjust this. You will get future maintainable profit before tax. Minus tax will be 40%. On this 40%. This will give us FMAP for goodwill. Our book answer and this answer differs because of income from investments and machinery they have taken in 2016. I do not know why, because it was purchased in 2014. So for goodwill valuation, 1,97,381 is the FMAP. I repeat for a minute. Any doubt in profit before tax? Any doubt in depreciation on the omitted mission? Overvaluation of stock is adjusted in 2016, also adjusted in 2017. Loss on sale of furniture is an abnormal item not to be considered. Bad debts to be eliminated. Income from non-trade investments, 50% was purchased in 2016, eliminate 12,000 from there. And balance was purchased in 2017, means we hold both. 2,40,000 into 10% we eliminate. We get operating profit before tax. Okay, 3,83,150. Less increase in expenses, increase in R&D, additional depreciation on machine we provide. Ensure that you take the book value of asset, including omitted asset, 836,450 into 5%. Why 5%? Value goes up by what? 5% on the 10% depreciation. Future maintainable profit before tax minus tax will give us what? Future maintainable profit after tax for which valuation? Goodwill valuation. Please remember, we worked out only which profit? Future maintainable average profit. Have we copied this? Or other? See, now உங்களோட டெக்ஸ்ட் புக்ல இருக்கிற மிஸ்டேக்ஸ் சொல்லிடுறேன், so that பின்னாடி ரிவைஸ் பண்ணா you will not have trouble. Capital expenditure charging 50,000 is wrong here, and giving an information that investment was purchased in 2016, adjusting it in 2015. I do not know why they have done. So because of that, profit will differ. This is all correct now. 8,36,450, 5% appreciation on that, how much percentage? 10% na, it will come to what? 4182 on the mari varum. Increase in expenditure and all they have done correctly only. 20,000, 30,000 and all they have done correctly only. And for future tax also they provided how much? 40%. That and all is correct. Only the data I hope typed in the question would have been wrong. Data typed in the question would have been wrong. Now which one we have to work out next? Average capital employed. We have to work out which one? Average capital employed, because the return on investment is based on which one? Average capital employed. Start. Yes, it will take time. Please remember, we have to value goodwill. Aprama, we have to value which one? Shares. Shares are partly paid up shares. Shares are which one? Partly paid up shares. And be happy that only intrinsic value is asked. Yield value is not tested. Yield value is not tested. Over. Shall we? Start. Let us do it together, no problem. Calculation of average capital employed. Sir, why are we not taking net assets? Because look at the word used. Look at the word used. What is the word used for goodwill valuation? Yeah. In similar business, return on, is it given net tangible assets or capital employed? Capital employed always means what? Average capital employed. So start. Just what, tell me the values. You're going to do along with me. Don't wait. Assets. Assets. What are the assets we have to take? What are the assets we have to take? Goodwill will not be considered as an asset for goodwill valuation. Plant and machinery. Plant and machinery. Look at the working we have done. Plant and machinery. What is the book value, including omitted machinery? 8,36,450 plus 5%. Plus 5%. Revised value. Plant and machinery, including the omitted machinery. That will give us book value plus 5% will give us what? Revised value. What is the next asset? What is the next asset? Land and building. Land and building. What is the land and building given? 10 lakhs plus 5%. All assets plus 5%. Then which asset next? Furniture also. Furniture, how much is given? 1 lakh. Don't adjust that loss on sale of furniture. Do they tell that it is omitted from the books? No, that has been already recorded. Furniture book value is 1 lakh. Do they tell that that sale of asset was omitted in the books? It has to be rectified and all? No. In the profit we adjusted because it's a non-recurring loss. It's a non-recurring loss. 1 lakh plus 5%, how much it is? 1 lakh 5,000. Then what are the other assets? 2 lakhs plus 5%. Then please remember, we should take only for goodwill valuation, we should take only what? Trade investments. Trade investments, we have done a working. 20% are trade investments, which is valued 20% less than the book value. What is the fair value of the investment? 48,000. Non-trade investment should not be considered. For goodwill valuation, non-trade investment should not be. Share valuation include for goodwill valuation, it should not be considered. Trade investments not 60,000. Fair value of the trade investments. Stock. Will you make adjustment for stock? No. Please remember, closing stock of 2016 became what? Opening stock of 2017. This adjustment is for opening stock of 2017. Is it anything to do with closing stock of 2017? No. So sometimes students make an adjustment thinking that, okay, the closing stock is also overvalued in the market. How much? 2,10,000. Exactly, mislead பண்ற மாதிரியே கொடுத்திருப்பாங்க. 2,10,000 minus 10,000 like that people will do. Okay. Please remember that closing stock of 2016 became opening stock of 2017. Okay. That is not related to closing stock of 2017. Next. Debtors. 1,95,000 minus 5,000 bad debts. 1,90,000. Then cash and bank balance. What is the cash and bank balance? 2 lakhs. Less liabilities. What are the liabilities? From the end. Proposed dividend. Proposed dividend on equity. Loss from the end, let us come up. What is the proposed dividend? 30,000. Then tax. 2 lakhs. Then outstanding expenses. 20,000. Then creditors. 1 lakh. 50,000. Then deposits. Deposits also part of external liability only. What is the deposits? 1 lakh. Bank loan irka. Bank loan. Bank loan, how much is there? 50,000. Bank loan 50,000. Then 15% term loan. What is a 15% term loan? 1 lakh 50,000. Then debentures. 12% debentures, how much? 2 lakhs. Any preference share capital? No. Preference share capital should not be reduced for goodwill valuation. Yes, those things should be taken. Prepaid expenses, how much? 40,000. Loans and advances also. They are part of current assets. How much? 40? 45. Take up this and work out closing capital employed. This is your net assets or closing capital employed. What is the closing capital employed? 20,76,273. Minus, how to get average capital employed? 1 by 2 of current year profit after tax. 1 by 2 of current year profit after tax. இங்கேயும் நிறைய பேர் மிஸ்டேக் பண்ணாங்க. Average profit after tax 1 by 2 போட்டாங்க. Current year profit means this profit. 3,80,000. What is the current year profit? 2017 ஓட profit பாருங்க எவ்வளவு இருக்கு? 3,80,950. Wait பண்ணுங்க. 3,80,950 is profit before tax. அதுல current year tax எவ்வளவு percentage? Futureல தான் 40%. Current year tax எவ்வளவு? 50%. So on this apply 50%. So if you reduce that, you will get current year profit after tax. Here many students went wrong. They have taken this future maintainable average profit into 1 by 2. No. Closing capital employed means clear. Closing capital employed is nothing but assets minus liabilities minus half of the current year profit after tax. This is 2017's profit. Profit earned in 2017. That is 3,80,950 minus tax quota. You will get profit after tax. This into 1 by 2. This into 1 by 2. So this will give us average capital employed. What is the average profit we worked out? Future maintainable profit after tax எவ்வளவு work out பண்ணிருக்கோம்? 1,97,381. Future maintainable profit after tax how much? 1,97,381 less normal profit. Normal profit. How to do normal profit? 1,98,1035 into what is the normal rate of return given? What is the normal rate of return given? 10%. So will வரும் இங்க super loss வரும். Okay. No super profit. So no goodwill. கஷ்டப்பட்டு ஒர்க் பண்ணி no goodwill ஆன்சரா கண்டுபிடிக்கணும். ஆமா. Your average profit is less than the normal profit, so no super profit, there is no goodwill. No super profit, there is no goodwill. உங்களோட டெக்ஸ்ட் புக்ல குட்வில் வரணுங்கிறதுக்காக they would have done some mistake. What is the mistake is liability sideல they have reduced even preference share capital also. They have reduced which one? Preference share capital also, so that some super profit comes and some goodwill comes. இது எல்லாமே correct தான். But இங்க they would have done this. That is a mistake. So no super profit, no goodwill. Please remember, we worked out only 50% of the question. இல்ல இந்த கிளாஸ்லயே முடிச்சுக்கலாம், அடுத்த கிளாஸ்ல மறந்துடுவோம். ஓவர் ஸ்டார்ட். Intrinsic value. We'll start with net assets for goodwill valuation. What is the net assets for goodwill valuation? This much. What is the extra asset we can take? Non-trade investments we can take. For valuation of shares, we can take even what? Non-trade investments. So on the 3 lakhs, 20% are trade investments, 80% are what? Non-trade investments. The 2 lakh 40 also we can include it. Then we can include goodwill value if there is any. There is no goodwill. What is the extra liability will reduce? Preference share capital will reduce. What is the preference share capital? 3 lakhs. This will give us net assets before notional calls. Are partly paid up shares. Yeah. So add notional calls. Notional calls, partly paid up shares பாருங்க இருக்கு. 80,000 shares are fully paid up. 50,000 shares are only what? 8 paid up. You can collect. You can collect. For 50,000 shares, we will collect 2 rupees plus. For the 30,000 shares, we can collect what? 1 rupee. So 1,30,000 we can collect. This is the net asset backup. We'll go by which method? Equivalent units method. We'll go by which method? Equivalent units method. That is a logical and correct answer also. Okay. How many equivalent units? This 1,30,000 will be taken as X. 10 rupees face value. 10 rupees face value how much? 80,000 plus 50,000. It is like 1,30,000 X. 5 rupees face value. 5 rupees face value 36,000 plus actually 36,000 இல்லைன்னு நினைக்கிறேன். 1,80,000 divided by 5 போடுங்க கரெக்டா வருதான்னு பார்க்கலாம். 1,80,000 divided by 5 போடுங்க கரெக்டா வருதா? 36,000 plus 30,000. This into 0.5x. This into 0.5x. How much will come? 33,000x. So total equivalent value 1,63,000x. So value of x will be net assets backup divided by what? 1,63,000. So rupees 10 face value, that is X. What is the value? This value. Rupees 10 face value, comma 8 paid up now. This will have 2 rupees lesser value, minus 2 rupees. Rupees 5 face value, that is nothing but what? 0.5x. 0.5x will be nothing but this into 0.5. Then rupees 5 face value, comma rupees 4 paid means this minus 1 rupee. This minus what? 1 rupee. Clear? 10 rupees face value is this much. 8 paid means this minus 2. This minus 2. 5 rupees face value is this much means 4 rupees paid up value will be having what? 1 rupee lesser value. This they have done correctly. But final answer will be wrong because of other values. See, you can look at, they would have an equivalent method. 1,30,000 plus 33,000, what is the total? 1,63,000. So net assets divided by 1,63,000 put it, they would have worked out the value like 13.82. Okay, minus 2, they would have worked out for 8 rupees paid up value. 0.5x half the value, minus 1 rupee, they would have given the value like that. But the numbers would have been wrong because of other answers. But this is a correct answer for the question that is given. So valuation of goodwill took time. Share, you would understand non-trade investment will be included. Non-trade investment will be included. Goodwill has no value in this question because there is no super profit. Eliminate preference share capital also. This will give us net assets before notional call. After notional call, this is a net assets backup for equity shareholders. For which one? Equity shareholders. Then we work out the values. A minute run through before we close. From the beginning, let us run through before we close. Any doubt in this overvaluation of stock, undervaluation of stock? And abnormal loss of furniture is a non-recurring loss. We add it back. Bad debts to be provided against current year profit. We do it. Income from non-trade investment, 50% for the current year and 100% for the next year. We take it. Okay. I mean, first year 50% purchase paniriko. Next year full would have been there. Then most important is which one? Increase in R&D expenses 20,000 or other expenses 20,000, R&D 30,000. Additional depreciation and machinery போடும்போது ரொம்ப careful இருக்கணும் because machinery 8 lakhs include the omitted machinery and book value of the machinery you will get on that how much percentage? 5% appreciation, 10% depreciation. Future tax will be how much percentage? 40%. While working out average capital employed, let us be very, very careful. Okay. Trade investment we will consider. Prepaid expenses advance also part of which one? Current assets. Okay. Debtors after bad debts we get cash and bank balance, of course it is given. Then we get closing capital employed. Wait. Average capital employed, let us be very careful. 2017 or a profit before tax is how much? This adjusted amount. How much? Adjusted amount? 3,80,950. Other tax is 50%. Current tax is how much percentage? 50%. That into 1 by 2. We get average capital employed. So we see normal profit is not more than your FMAP, so no goodwill. Intrinsic value, we take net assets. Non-trade investment also part of shareholders' net worth, that will be included. Goodwill 0. Preference share capital you eliminate. You get net assets before notional call. Since there are partly paid up share, we make notional calls and collect. So we find out equal number of shares. 10 rupees share is 13.1673. 8 rupees paid up will be 2 rupees lesser than that. 5 rupees paid will be half of the X value. 4 rupees paid will be 1 rupee lesser than that. Now at home, what I request is go through this once again. Then try question number 22. Try question number 22, for which solution is also available in ICMA material, which is correct. They ask you to find out which one. Goodwill at 3 years purchase of which one? Closing capital employed. அதே மாதிரி return on closing capital employed தான் கொடுத்திருக்கோம். The NRR is given based on which one? NRR is given based on closing capital employed. No need to work out average capital employed. So first find out value of goodwill, then find out which one? Intrinsic value, then yield value. Intrinsic value plus yield value divided by 2 will give us what? Fair value. By discussing this question, we'll start the next class where We'll see 23, 24, all those things. So try the question number 22. Must try it at home today.